This window won't last long. Gold and silver are being shoved around by forced flows, while the real market underneath is getting tighter. And the conflict is simple. The screen price is getting bullied by calendar mechanics and positioning, while physical signals are quietly flashing demand in places that matter. If you stay with me, you'll know exactly what the hidden pressure point is, what the next 1 to 2 weeks can force funds to do, which levels flip the setup from healthy reset into continuation squeeze, and the single checklist that tells you whether this move is real or just noise. Here's the part most people get wrong right at the start. When gold dips a couple tenths of a percent and silver wobbles, the default story becomes profit-taking and the rally is tired. But the tape doesn't care about your story. Price is an output of flows. And some of those flows aren't opinions. They're obligations. They're mechanical. They happen because of how commodity benchmarks rebalance and how large pools of money are forced to adjust exposure on a calendar. That matters right now because we're not in a random week. We're in the kind of week where liquidity is thinner, participants are resetting risk budgets, and one macro data print can move the dollar and yields in a matter of minutes. And that's where the real pressure starts. Let's put quick context on the board so we're not floating in vibes. As of today, spot gold has been oscillating around the bid $4,400 per ounce after recently printing record territory up near the mid 4,500s. And it's still on track for a strong weekly gain even after a mild pullback. Silver has been even more dramatic, hanging around the high 70s after ripping to fresh highs earlier this month and then snapping back hard. Because silver doesn't walk, it lunges. That's not a moral judgment, that's market structure. Silver's liquidity profile and positioning profile make it the more violent instrument, especially when the marginal buyer changes from someone wants a little to someone must have a lot. But that's not the part that matters. What matters is why the pullbacks are happening at the same time. The underlying signals are getting louder. Start with the on-the-ground symptom that most macro tourists miss: physical premiums. If this were a purely speculative paper rally, you'd expect physical markets to yawn, to offer discounts, to have plenty of metal sitting around waiting for buyers. Instead, you're seeing a split that tells you exactly where real demand is waking up. In India, elevated prices have strained retail jewelry demand, and local premiums have softened. That's normal. When prices surge, the price-sensitive buyer steps back. But at the same time, China has seen premiums widen sharply, jumping from single digits to north of $20 per ounce over global spot levels. In some reports, because physical demand there re-engaged after holiday timing, and supply didn't instantly appear to meet it. That divergence is a clue. It says the market isn't one blob. It's a network. Metal has to move, and when premiums widen in a major hub, arbitrage wakes up, but only if the plumbing can handle it. Keep that thought, because it ties into the hidden detail in a way that changes how you should read every dip. Now zoom out one notch and ask, who is actually bidding? Because it's easy to look at India's weaker jewelry demand and declare the bull case dead. That's lazy. Jewelry is important, but it's not always the marginal driver at turning points. When gold shifts from consumer good to strategic asset, the marginal buyer becomes institutions, central banks, reserve managers, and funds allocating to macro uncertainty. That doesn't mean price goes up in a straight line. It means the dips get bought differently. It means the market can stay bid even when the storefront is quiet. And it means silver can go from industrial metal with a side of speculation to monetary metal plus procurement panic very fast. And that's where the next detail flips the whole setup. Here's the hidden detail you need to anchor on. A meaningful chunk of this week's selling pressure is basically pre-programmed. It's not a sudden collective decision that gold is over. It's the annual commodity index adjustment and rebalancing flow, large, systematic allocations that roll exposure and rebalance weights, often around the start of the year. When those flows hit, they can lean on futures prices regardless of whether physical demand is tight or macro demand is rising. The market can look like it's rejecting higher prices, when in reality, it's digesting mechanical selling and repositioning. That's why the window is real. If the underlying bid stays intact while the mechanical pressure passes, you can get a cleaner runway for the next leg. But, and this is important, that only happens if the market absorbs the flow without breaking key structure. Because if one level breaks, the math changes. So let S demystify what I mean by paper versus physical without turning this into a lecture. Futures markets are the steering wheel. Physical markets are the road. Most days, the steering wheel points where the road goes. But during stress, the steering wheel can twitch violently even when the road underneath hasn't changed much. Futures are where leverage lives, where positions are marked to market every minute, where margins force behavior. Physical is where metal is actually delivered, stored, refined, and shipped. When futures sell off because funds are rebalancing or because the dollar spikes after a data print, physical doesn't instantly flood the market with new bars. It can't. Supply chains have lead times. Refining has bottlenecks. Logistics have friction. So you can absolutely have a situation where screen price drops while physical premiums widen in certain regions. That's not a conspiracy, that's a mechanism. And once you understand it, you stop letting a red candle bully you into a bad decision. But we're not done, because the really tradable part is how arbitrage and inventories translate that tension into future price discovery. Let's talk inventory the right way, because this is where people get faked out. Inventory is not one number, it's categories. It's deliverable versus non-deliverable. It's registered versus eligible in some systems. It's allocated versus unallocated in others. The difference between metal exists in a vault, and metal is actually available at this price for delivery. A headline inventory number can look comfortable, while the deliverable pool is tight. And tight deliverable pools are where squeezes are born, because futures markets ultimately rely on the credibility of delivery and settlement. If the market senses that getting metal now is harder than the curve is pricing, the front end can tighten, spreads can move, and suddenly the screen price is forced to respect the physical world. But that's not the part that matters. The part that matters is what you can watch this week, in real time, to know whether that pressure is building or releasing. This is where term structure becomes your lie detector. You don't need fancy software to understand it, you just need the idea of time. In a normal, well-supplied market, later delivery can trade slightly higher than near delivery because of financing, storage, and carry costs, what people call contango. In a stressed market, the opposite can happen. Near delivery can become relatively more expensive because people want metal now, not later, backwardation. You don't need to bet your house on the curve flipping. You need to watch whether the front end is tightening relative to the back end during dips. Because if price pulls back but the front end spreads refuse to relax, that's a market telling you there's still urgency under the hood. And that urgency forces behavior. It forces shorts to respect delivery risk. It forces arbitrageurs to move metal. It forces dealers to manage inventory more defensively. And those are not vibes. Those are constraints. Now, layer in the calendar, because the calendar is the catalyst frame for this entire alert. We're in early January. Many desks are still coming back to full risk. Liquidity can be thinner than it looks, especially outside peak hours, which means price can gap through levels that would normally hold. At the same time, the annual rebalancing and index adjustments can create one-way flow. And right on top of that, the market is staring at the US jobs report and the rate path it implies. That's a perfect storm for whipsaw. Mechanical flows leaning on price, macro data snapping the dollar in yields, and positioning that's already crowded from a powerful run. You can be correct on the macro and still get chopped if you ignore the timing, because volatility will be used against you. And that's where most people lose money in bull markets, on the path, not the destination. So let's build the proof stack properly. Multiple layers, different angles, all converging. Proof point 1 is price context itself. Gold recently printed record territory and is still up strongly on the week even after mild weakness, which tells you the underlying trend is intact unless structure breaks. Proof point 2 is the explicit acknowledgement of mechanical index-related pressure. When a market is being leaned on by benchmark adjustments, you should expect short-term dislocations that don't reflect fundamental demand vanished overnight. Our proof point 3 is the regional physical premium divergence. Weaker retail jewelry demand in India, alongside widening premiums in China, is exactly what a segmented, tightening physical market can look like during a price surge. Proof point 4 is the behavior of silver. Sharp surges and sharp pullbacks are consistent with a market where participation and leverage amplify moves, not with a market that's calmly topping. Proof point 5 is the macro trigger stack. The dollar and yields are in play around major data, and that directly influences metals via opportunity cost and cross-asset positioning. And we're still not done, because the most tradable proof point is what participants are forced to do in derivatives. This is where options and dealer hedging can quietly pour gasoline on an already hot move. When there's heavy call buying or large option open interest near key strikes, dealers who sell those options often hedge by buying the underlying as price rises and selling as price falls, depending on their exposure. In certain setups, that hedging can create reflexivity, moves that feed themselves. If price pushes through a strike zone where a lot of options sit, hedging flows can accelerate the move because dealers need to buy more as delta changes. That's not magic. That's math. And silver, with its tendency to attract speculative options activity, can feel this harder. I'm not telling you options are the whole story. I'm telling you they can turn a normal breakout into a move the market can't unsee. And that's why levels matter more than narratives. So let's get concrete about levels without pretending we can predict tomorrow's candle. For gold, the obvious ceiling is the recent record zone in the mid $4,500. That's the level the market just proved it can touch. Above that, there's open air psychologically, but markets don't levitate. They test, they retest, they bait, they punish. The first support zone I'm watching is the mid 4,400 crude hundreds, where spot has been holding around the current pullback area. If that zone holds on closing bases while the dollar and yields do their dance, it tells you bids are real. A deeper support zone sits closer to the low 4,300s, an area gold traded earlier this month. I was talking to you because that's where you start to test whether this is a reset within a trend or a breakdown of trend. If gold were to lose that deeper zone and fail to reclaim it quickly, that's when you stop romanticizing the story and respect that the market needs more digestion time. That is your invalidation line in practical terms. Not the thesis is dead forever, but the near-term squeeze setup is off and you need to reassess. Because if this one level breaks, the math changes. For silver, you have to frame it with wider bands because it swings. Silver recently traded above $80 earlier this month before pulling back toward the high 70s. That prior spike zone around $80 to $81 becomes an obvious resistance cluster, a place where trapped sellers may reappear and where momentum buyers will want confirmation. On the downside, the mid to high 70s is the first battlefield. If silver holds that region on pullbacks and then reclaims momentum, it's a strong tell that dips are being absorbed. A deeper line is in the low 70s, levels silver traded at the start of the month. If silver loses that and stays there, you're likely in a longer consolidation and you need to stop treating every bounce as the next explosion. That's not pessimism, that's risk management. And you need it, because silver is the instrument that can be right and still hurt you if you're oversized or emotionally reactive. But here's the twist. The very violence that scares people out is what creates the squeeze case when the setup is real. Now, let's map the two scenario lens so you don't get hypnotized by one outcome. Scenario 1 is the controlled pullback and retest. This is the healthy reset path. Gold digests mechanical index flows. The jobs report whips the dollar, price dips into support, finds bids, and then grinds higher as the flow pressure passes. Silver does something similar but with more drama. Sharp dip, stabilization, then a push back toward the prior highs. In this scenario, the confirmation is boring, and that's the point. Price stops reacting negatively to bad headlines. Dips get shallower. Intraday sell-offs get bought. Physical premiums stay firm in tight regions. Front-end spreads do not collapse. And the market starts stepping up again. If you see that, the window is open, and the market is telling you the path is upward even if it's not comfortable. Scenario 2 is the continuation squeeze. This is the no polite entries path. In this scenario, gold reclaims the record zone quickly and forces systematic money and trend followers to chase, especially if yields soften or the dollar rolls over after data. Silver, because it's silver, can gap higher and rip through resistance as shorts cover and option hedging amplifies the move. This is where you get the air pockets, moves that happen so fast that social media can TIs process them until they already done. The confirmation here is acceleration with stability. Price moves higher and refuses to give back gains, even when the news cycle tries to scare people. But, and I need you to hear this scenario carries gap risk in both directions. Squeeze markets can rip, and they can also snap back violently when liquidity thins. If you're not built for that, you don't need to prove you're tough. You need a plan, because volatility will be used against you, and that's not a theory. That's how markets transfer wealth from the impatient to the disciplined. So what does the other side do during this? What do institutions, dealers, and funds get forced to do? This is the so what that turns mechanics into action. If you're a large commodity index tracker, you rebalance regardless of your feelings. If you're a macro fund that made money on the move, you might trim into strength to manage risk, especially ahead of a major data print. If you're a dealer in physical markets, you adjust premiums based on real availability and demand, not on a tweet. If you're a miner or a refiner, you cannot double supply next week just because price is high. Lead times and capacity constrain you. If you're an industrial buyer, you may accelerate procurement if you fear higher replacement costs or supply bottlenecks. And if you're short futures in a market where physical signals tighten, you begin to respect the risk that rolling shorts forward isn't free anymore. That's how squeezes form, not because of drama, but because of constraints. And constraints don't negotiate. Let's talk supply chain for a minute, because this is the quiet backbone of the entire window idea. Even at high prices, new mining supply does not appear overnight. Projects take years. Permits, capital, labor, equipment, geopolitics, none of that moves at the speed of a chart. And silver has an extra twist. A large portion of silver supply is byproduct, meaning it comes out of mining other metals. That means the silver supply response is even less elastic than people assume. Recycling helps, but it has limits and it's sensitive to collection, refining capacity, and economics. Refining and logistics add another layer. Bars and coins are not magically interchangeable across all markets and specs without time and cost. So when physical hubs show tightness, the path to relief is not instant. That doesn't mean price only goes up. It means the physical world can put a floor under the market when the paper world throws a tantrum. But that's not the part that matters. The part that matters is how arbitrage translates that floor into price. Arbitrage is the bridge between premiums in one region and global spot price. If gold is trading with a large premium in China relative to global spot, there is an incentive to move metal there. Buy where it's cheaper, sell where it's dearer. But arbitrage is not frictionless. You need available bars that meet specs. You need financing. You need transport and insurance. You need timing, and sometimes you need regulatory clarity. When those frictions rise, premiums can stay elevated longer than people expect, and that's a tell that the physical bid is real. Meanwhile, futures prices can dip because funds are selling mechanically. That's exactly the tension that creates opportunity windows. Because if the physical market holds firm while paper flow pressure fades, the futures market can snap back as the steering wheel realigns with the road. And when it snaps back, it can do it fast. Because the same funds that sell mechanically can become buyers again once their rebalance is done. And that's where the trade becomes asymmetric. Now, I want to build your viewer psychology shield, because this is the difference between making money and making mistakes. When metals are in play like this, the market's favorite weapon is emotional manipulation through volatility. First, you get the euphoric spike. People chase late. Then you get the sharp drop. Headlines scream bubble. People panic sell. Then the market stabilizes, grinds, and rips again without them. It's a rinse cycle designed by incentives, not by villains. Dealers hunt liquidity. Funds manage risk. Algorithms react to momentum. Your job is to stop being the liquidity. So here's the rule. Separate trend signal from noise. Trend signal is structure holding, higher lows in gold, silver holding key bands, physical premiums not collapsing, and the market absorbing forced selling without breaking. Noise is the intraday whip around a jobs print, the 1-hour candle that looks like doom, the influencer screaming certainty. If you can't tell which is which, you don't need more opinions. You need a checklist in position sizing that lets you survive being early. And survival matters because even if the thesis is correct, price can whip around violently. Gold can be up on the week and still drop hard on a single day. Silver can move several percent in hours. If you're leveraged, that's not excitement. That's liquidation risk. Margin calls don't care about your thesis. So the psychology shield is practical. Size, so you can hold through normal volatility. Avoid making decisions during the first reaction to a major data print. Predefine your invalidation line, where the setup changes, so you're not improvising in panic. And remember that institutions often use volatility to improve their entry, not to prove the story wrong. They buy when it feels uncomfortable, not when it feels safe. That's why the crowd gets chopped. But here's the twist. You don't need to outsmart institutions. You just need to stop playing their favorite game. So what comes next, specifically in the next week or two? Here's the near-term roadmap. First, watch the jobs report reaction. Not just the headline number, but what it does to the dollar and yields. Metals respond to real rates and currency moves because they change the opportunity cost and the global purchasing power dynamic. If the dollar strengthens sharply and yields jump, you can see metals dip even if the longer-term story remains intact. If that dip is shallow and quickly bought, it's a sign of strength. Second, watch how gold behaves relative to that recent support band in the mid-4400s and the deeper band in the low 4300s. If gold holds those and reclaims upward momentum, the window remains open. If it loses the deeper band and can't reclaim it, the window narrows and you shift from alert to patience. Third, watch silver around the high 70s and how it responds as it approaches the 80-81 region again. A clean reclaim with follow-through suggests squeeze dynamics are alive. Repeated rejection with weak bounces suggests consolidation. Fourth, watch physical signals. If China premiums remain elevated while India stays soft, it tells you demand is concentrated and arbitrage pressure persists. If premiums collapse everywhere, it tells you physical is relaxing and the rally may need more time. Fifth, watch market structure cues. If near-month spreads tighten during dips, it signals urgency. If spreads relax hard and liquidity feels heavy, it signals digestion. And the next detail is what flips the whole setup. Watch whether price starts ignoring bearish headlines. When a market stops going down on bad news, it's usually because the sellers are exhausted or the buyers are stronger than the narrative. That is one of the cleanest tells you'll ever get. Now, I'm going to address the skepticism head on because your audience is right to demand counterpoints. Yes, at these price levels, you can absolutely get demand destruction in traditional consumer channels. India is a prime example. People buy less jewelry when prices surge, they shift to lighter pieces, or they substitute. That can cap rallies, especially in the short run. Yes, if the dollar rips higher and real yields rise, it can pressure metals. Yes, profit taking is real. And yes, some forecasts floating around the internet are sensational. You don't need sensational, you need mechanisms and risk framing. The question is not whether there will be pullbacks. The question is whether pullbacks are being absorbed by deeper buyers while physical and structural signals remain firm. And right now, the evidence points to a market where the dip is being influenced by calendar mechanics and risk management, not a market where the entire rationale just evaporated overnight. But that doesn't mean you bet blindly. It means you watch the tells. Let's make it even more tangible with a quick forced behavior translation. If gold remains supported even after index-related adjustments and ahead of major macro data, it tells you there's a persistent bid. That bid is often institutional. If gold pushes back toward record territory and breaks through with volume and stability, it can force trend-following systems to increase exposure because their models respond to breakout confirmation. If silver stabilizes and then reaccelerates, it can force shorts to cover due to volatility and risk limits, and it can trigger dealer hedging flows if options positioning is clustered. On the other hand, if gold breaks the deeper support zone and stays below it, funds that are sensitive to drawdowns may reduce exposure, turning a dip into a longer consolidation. If silver loses the low 70s region and fails to reclaim, the squeeze narrative pauses, not dies, pauses. And that distinction matters because it keeps you from turning one bad week into a permanent story. So what do you do with this as a finance-minded retail investor or macro watcher? You don't need to trade every candle. You need to respect that this is a window shaped by the calendar. Mechanical flows and data-driven volatility can create mispricings. Your advantage is patience and process. Set your levels. Know your scenarios. Don't confuse a shakeout with a breakdown. And don't confuse a spike with a guarantee. The best way to handle a market like this is to treat it like a storm. You don't argue with the wind. You adjust your sails. Small, deliberate decisions beat emotional all-ins. And if you're a skeptic, good. Skepticism is protective, but aim it at your own impulses too, not just at institutions. Here's the subtle warning most people want and say out loud. When a market becomes headline sensitive, the headlines become a weapon. Not because someone is writing them to target you personally, but because your attention is predictable. A scary headline plus a fast red candle triggers panic. A euphoric headline plus a fast green candle triggers chasing. Both are bad entries. The antidote is pre-commitment. Decide in advance what confirms the thesis. Gold holding key support while absorbing forced flows. Silver stabilizing. And reclaiming momentum, physical premiums remaining firm where demand is real, and macro not turning into a sustained dollar wrecking ball. Decide what weakens it. Support breaks and fails. Premiums collapsing broadly, spreads relaxing sharply, and price reacting violently lower to minor news. Then you act based on your checklist, not your pulse. Now I'm going to give you the cleanest next week checklist in plain language. 1. Does gold stay above the mid 4400s band after the jobs report reaction fades? 2. Does gold avoid a sustained drop into and through the low 4300s band? 3. Does silver defend the high 70s area and show signs of building higher lows? Or does it bleed into the low 70s? 4. Do physical premiums remain elevated in China relative to global spot, signaling tightness and real bidding? 5. Do you see dips being bought quickly, especially during off hours when liquidity is thinner? If you get yes on most of these, the window is open and the base case retest scenario is likely. If you get no on most, the window is narrowing and you shift to patience. If you get mixed signals, you wait for confirmation rather than forcing a trade. That's how you stay alive in a market designed to shake you. And I want to end with the identity piece because it matters more than any single call. The people who win in metals over time aren't the loudest. They're the ones who respect structure, understand the plumbing, and don't let the market rent space in their nervous system. If you're here for mechanisms instead of slogans, you're already ahead of the crowd. And if you want to keep building that edge, watching spreads, understanding why physical premiums can diverge, knowing when calendar mechanics are distorting price, stick with this style of analysis because it's how you stop being surprised. Drop in the comments what levels you're watching for gold and silver, and whether you're seeing physical tightness where you live because those ground truth signals matter more than hot takes. This window won't last long, and the market is about to show its hand one way or the other. Stay disciplined, stay curious, and let the checklist, not emotion, make the decision.